So GDP came in very strong for Q1, which is roughly 3 months ago. And jobless claims not doing anything too crazy. So recession must be canceled, of course. And we can take all the bearish ideas and throw them in the trash bin. That is not my interpretation, and I don't think that's the interpretation of the Fed, particularly after they made just yesterday a distinction between a hard landing and a recession. It was previously thought that the only possible outcome would be between a hard landing and a soft landing being no recession. They have said that they won't cut rates just because there is a recession. And most times when we try to get inflation down, most hiking cycles, there actually is a recession. So it's not an outlandish claim to assume that there will be a recession. Additionally, here's the nail in the coffin, in my opinion. Bostic, who doesn't want to hike rates again, says we are only at the beginning stages of feeling the effects of the rate hikes. So if we're only at the beginning stages of feeling the effects of the rate hikes, why are we projecting that there will be no recession based on data we got from 3 months ago? Right? Where are all the people complaining about how we're looking at backward-looking inflation data? That backward-looking inflation data is only a few weeks old. This GDP data is several months old. Very different picture. Very different picture, in my opinion. So I think interest rates have gone higher, and they're going to continue to go higher. And the 10-year has just hit its highest level since the pre-SVB era. The post-SVB era has been a big outperformance by tech. Since SVB, that was really a pivot point for this market. We were in the same kind of trajectory and paradigm that we were experiencing throughout 2022. And once SVB happened, the immediate reaction was the Fed is done. They would be crazy to hike again. There's no way there's going to do that. People were pricing in multiple rate cuts by year end. And the Fed has since hiked twice, forecast to hike at least 2 more times, and no rate cuts until well into next year. So that picture, the tightening picture, has changed. It's gone to more economic tightening, highest interest rates we've seen since pre-Great Financial Crisis. And the full effects of the tightening are yet to be felt. Now, some might point to today and say, oh, the market's essentially shrugging this off. The NASDAQ was, basically closed flat, and most of the market was up. Well, yes, the Russell and the Dow were up, and it is technically good to see the Russell up from an economic perspective. But I don't know if that was necessarily around the GDP report. I think that was about the banks. You look at the KRE, that's up 2%. You look at Goldman Sachs. Goldman Sachs should be down today. You look at the projected losses they're going to experience in that stressful situation from commercial real estate and consumer credit. They lead both those categories in losses. Goldman Sachs leads both those categories, consumer credit and commercial real estate. Those are the two areas in the line of sight. So why is that stock up over 2%? I think people clearly did not look at this. Obviously, the Fed was not going to say any of the banks failed the stress test when we just had massive bank failures. And let's not forget, this is only a stress test done on large banks. They did not test smaller banks. They tested highly regulated, highly scrutinized, higher capital requirement banks, and one of the banks led in the two most important categories, and that was Goldman Sachs, and was up over 2% today. I think that's crazy. I wanted to go short it. If it wasn't down so much already, I probably would have done that because, we know commercial real estate losses are happening. David Solomon has talked about several times in the past few weeks about, essentially more stress is going to come. He's talked about his individual bank portfolio. It's going to have problems. He's talked about the need for more consolidation in the banking sector. I think Goldman Sachs is now a red flag. That's my opinion. We'll see what happens, but I'm looking at this. I think Goldman Sachs is an actual red flag, yet is up 2% today. So to see, the Russell up, I don't think it's any big deal, okay? It's not any big deal. The GDP report, no big deal. I think what's more important is that the Fed seems to think that future tightening of the economy is coming. And I think that's reasonable to assume. So, based on what we heard from Walgreens on Monday, based on what we heard from General Mills either on Tuesday or yesterday morning, and based on what I was saying after the Micron earnings last night, and based on what that stock did immediately at the open today, I think it's safe to assume that the forward-looking picture of the consumer is not the same as the backward-looking picture of the consumer, particularly when wage growth slows, consumer credit continues to go up, unemployment rises, and interest rates rise, and asset prices fall. Asset prices fall. You look today, mortgage rates at 7%. That's going to be a big nail in the coffin. You want to take some money out of a refi? It's not going to happen. You want to sell a car? You're going to get a lower price. That's just the reality of the situation. So I think, if you want to just look at one GDP report from 3 months ago, 1.4% expected, 2%, let's go. You can do that. That is your prerogative. You can do that. I'm looking at all these things, and I'm not as optimistic. Nike just reported earnings. Yes, it was down bigger right when they did it, but let's see what it is now. I don't know what it is now. It's down slightly. Let's see what the guidance is going to be. That's what really matters. The guidance I've heard so far this week, not so good. Really not so good. So I don't think it warrants extreme optimism. And you look at Nike, right? This is a great business. They sell good products. People buy these products. It's been around forever. It's going to be around forever. But guess what? The stock hasn't done that well this year. Before this earnings, it's down 4.5%. Why? Why is Nike down? Why is Nike down? You know why Nike's down? Because it's not cheap. It's an expensive stock. Sure, it's cool to own Nike, and sure, it's Nike, but it's not cheap. And that's the same with a lot of this market. Think about it for a second. You're buying a stock because not so you can just offload it to the next person. That's not what you're supposed to do, at least. You're investing in a business because that business is going to generate a very good return on your investment. You're going to put money in, and they're actually going to make an acceptable amount of money. That you're going to give them $1,000, and they're going to make $100, $200 or so per year. Some meaningful amount of money. You give Nike $1,000, they make $30 per year, and you don't see any of it. You see $10 a year. It's crazy to me. So I think this stock deserves to be lower. I don't, even if it does well, I think it deserves to be lower. And I think that's the case with a lot of the market. And interest rates started to reel that truth back in a little bit. That, you could actually not get ripped off by investing in a stock. But look at it now. The 10-year is on the verge of breaking out. That is the risk-free rate of return. You can just sit back, relax, and make money. You don't need to get ripped off in this company that has basically let a lower yield, assuming no earnings growth. Obviously, earnings are going to grow, but Nike's earnings did not grow despite their revenue growth. And we'll talk about that in a second because that's a much more important, broader trend. Anyways, interest rates going higher means valuations have to become more acceptable because, like we said at the beginning of the video, we're not in the all clear in the recession camp. We're not. It's just not the case. The companies reporting earnings this week, they're all saying the future outlook is tough. Even Micron said profitability and cash flow for an extended period of time is going to remain tough. So why are we paying ridiculous amounts of money when earnings have already begun to decline despite GDP growth in Q1? Okay, get this through your head. Q1 earnings growth declined despite GDP growth. We don't buy GDP. We buy earnings. And earnings declined. That's what matters. Now, why did earnings decline? Not because necessarily of revenues, although in many instances revenues did decline, but because margins declined. Nike's margins also declined. Gross margins for fourth quarter decreased 140 basis points to 43.6%. Now, this is another thing the market has gotten wrong. Oh, inflation comes down. That's it. We're done. Boom. Let's go to the moon. No. Remember Mike Wilson, when he put that thing out at the very end of 2021? It was fire and ice. Fire and ice. It's not just inflation. It's just not just a CPI report. It's not just another rate hike, okay? It's bigger than that. It's inflation, which allowed earnings growth to be well above natural levels, is now being reversed, and companies have to adjust to that new reality. They have to discount products. They have to lower prices. They can't take price. That was a big thing during inflation, during COVID. Companies just taking price. We're just going to take price. And that allowed them to adjust for inflation. Guess what? It's being reversed. So not only do you have higher interest rates, you have falling inflation, which is going to hurt businesses and earnings and margins, and you have, in my opinion, overpriced valuations. It is not a good combination to buy a lot of businesses at this time. There are some businesses to buy. I think energy stocks are very well priced. They don't suffer from these problems. They actually are cheap. They're actually a good deal. They actually pay you money, and Warren Buffett is actively buying them versus selling stuff like BYD. So I think a lot of this stuff is expensive. I'm not a fan of it. I'm not a fan of the market here. There are a few things I like, but they are few and far between. So that's today's video. We'll see what happens. And until next time, peace out.